Good morning. My name is Simnikiwe Tuta and I am a client fund manager for Momentum Investments within the institutional distribution team. It is my pleasure to welcome you to our new virtual 3D studio, which we specifically built for our Moments with our Investment Gurus events. It's over a year into the pandemic and our investment landscape has shifted significantly. Even with the time that has passed, we still find ourselves uncertain about the impact of the pandemic in our lives. In the South African context, we find that we can't predict the timing, the severity, and the period a wave will last. The extent of lockdown restrictions is often driven by managing the delicate balance between curbing the spread of the virus and the impact on the economy. This makes business planning and strategic formulation difficult, making it even harder for investors in their stock picking and asset allocation. Investors have had to adapt their thinking to which industries will emerge better or worse from the pandemic. In South Africa, there is a pickup in sectors such as banking and telecoms. We've seen how businesses have evolved and e-commerce and digital adoption has accelerated. The ability for businesses and people to have transition reflects the resilience of the human spirit and the adaptability of the business community. We are here today to share with you how our investment gurus are responding and how we think markets will develop. Though there is a lot of uncertainty, we still believe there is opportunity for you as our clients. We're excited to share with you the trends we've seen in the investment markets, the increased interest in alternative investing, and the broader effect of the pandemic in the economies we invest in. Our investment specialists will be ready to answer any questions you may have during the event, so please post your questions in the question and answer box for us to respond to them. If you need any more information regarding our capabilities or investment solutions, please request a call back and we'll get back to you as soon as possible. For those of you who need CPD points, if you have watched the full session, your CPD certificate will be emailed to you once the CPD points are authorized. The videos of this session will be available on our website momentum.co.za under Investments and Savings. First up is Herman van Pappendorp, our Head of Investment Research and Asset Allocation, who will be giving us an overview of the macroeconomic environment.
Thank you, Simni. Good morning, everyone. Thanks for tuning in. Today, I want to talk to you about the two related asset classes that dominate all investors' portfolios: global and South African equities. Let me start off by taking you back to our thinking early December last year when we published our 2021 Financial Market Outlook report. Firstly, we envisaged then that a positive vaccine outcome and more geopolitical predictability under President Biden would provide a conducive environment for riskier asset classes like equities in 2021. Secondly, we thought that an improved global growth picture, together with ongoing ultra-easy policy settings, would reward less risk-averse investment behavior in 2021. At the time, it also looked to us as if the stars were finally aligning for the South African equity market, with a strong expected local profit recovery in 2021, providing the necessary fundamental support on top of the visualized conducive global risk-on environment, while a more favorable valuation underpin after years of poor performance would enhance potential return upside. So far, these views have very much panned out, with global equities up 17% and South African equities up 15% in the 7 months since the publication of our year-ahead report. As we are now past the midpoint of 2021, it is an opportune time to take stock of our views on both global and South African equities. So let's start with the main driver for global equities: company profits. On this slide, research from Citi shows that over the past 50 years, global equities typically do well in the year before corporate earnings trough, with the profit trough depicted by the first vertical grey dotted line on the graph. With global equities continuing to give good returns in the first year of profit recovery after the trough, the area on the graph between the two vertical grey dotted lines. Only in the second year of a profit recovery, the period on the graph to the right of the second vertical grey dotted line, does the equity return profile normally become more erratic, with intermittent periods of drawdown experienced. With global equities having troughed in November last year, historical precedent would indicate decent global equity returns until later in 2021, with maybe more volatile equity return behavior from then onwards. A big question currently for global equity market direction is whether profit momentum or the absolute level of profits will be the dominant driving force for global equity returns from now on. For instance, year-on-year US profit growth will likely peak at a very high level in the second quarter of 2021 due to the very low earnings base created a year ago at the height of lockdowns. I've highlighted the huge base effect on US profit growth in the second quarter of 2021 on this slide by the red dotted circles and the red dotted arrow. However, the absolute level of US corporate profits is anticipated to rise further into 2022 as economic recovery unfolds, as can be seen in the red bars on the right-hand side of this slide. If markets are indeed able to discard the outsized base effect causing the peak in profit growth in 2021 and rather focus on the general uptrend in profit levels that remains intact until 2022, equity prices can still go higher. Another very topical theme in markets at the moment is the rising inflation trends experienced around the world, mainly due to the combination of 1, accelerating economic growth momentum, 2, supply bottlenecks in a number of products, and 3, again, the low base created for goods and services prices during the height of lockdowns a year ago. Rising inflation in itself is not necessarily a problem for equity returns if this turns out to be only a temporary phenomenon. But should more aggressive monetary tightening be required if higher inflation becomes entrenched, this would become a bigger threat to equity valuations and returns in due course. This slide shows that the global inflation trend does matter for asset allocation. By looking at historical one-year forward returns for US equities in the blue bars and US bonds in the red bars during different inflation regimes. The most favorable inflation regime historically for absolute and relative global equity returns was when inflation was below average and rising. The scenario depicted second from the left by the blue and the red bars. In the current phase of above trend and rising inflation, as highlighted in the grey block, global equities still normally outperform global bonds in the past, but with lower absolute and relative equity performance. So both profit and inflation trends are thus still supportive of global equities for now. However, there are some factors that point to a rising probability of some pullback or correction in equity markets from the second half of 2021. This could firstly be ignited by the likely initial discussion and eventual announcement in the coming months by the US Central Bank of its plan to start cutting down its asset purchases, most likely from early next year. Furthermore, a closing US output gap before the end of 2021, a weak seasonal time period in equity returns from now until September, as well as the historical frequency of drawdowns, also point to the potential for some downside risk to equity prices in future months. This table summarizes an analysis by Credit Suisse that shows minor equity pullbacks of 5 to 10% occurred roughly once a year over the past 30 years, and 10 to 20% corrections happen broadly once every 3 years. If one measures the time elapsed since the last pullback and correction respectively, it looks like we are soon due for some drawdown, if the average historical precedent repeats itself. However, a full-blown equity bear market defined as a larger than 20% drawdown looks unlikely anytime soon, as this comes around only once a decade and last took place just over a year ago. Also, the massive policy stimulus and liquidity support still prevalent in the financial system, as well as rising profit levels, should limit the magnitude of any equity downside for now. Only as we move closer to the expected US interest rate increases in 2023 do we think the downside risk for equity markets would become more acute. We thus think the appropriate investment response to any potential near-term pullback or correction in global equity markets would be to remain invested or at most to buy any dip in anticipation of a relatively quick recovery in performance after any drawdown. Similar to the case for global equities, there is also still strong fundamental profit support for the South African equity market. Since South African corporate earnings bottomed at the beginning of 2021, the upward trend in earnings revisions have continued unabated, with company profit upgrades by analysts currently outpacing downgrades by around 30%, as can be seen in the grey highlighted block. This has kept South African equity valuations in check and underpins attractive forward return expectations, both in absolute terms and relative to both emerging market and developed market equities. In the left-hand graph on this slide, we show that whereas the South African equity market on average traded in line with emerging market equities on a forward PE basis in the last 25 years, the red horizontal line, it now trades at a much larger 30% discount to emerging markets. Even more so, the right-hand graph shows that where South Africa on average traded at a 16% discount to developed market forward PEs historically, again the red horizontal line, it now trades at a massive 50% discount. Furthermore, assuming consensus earnings growth of 34% in the next year, this slide shows that the South African equity market's forward PE is now slightly below its own average since 1999, the horizontal grey line on the graph, and more than 2 standard deviations below the average since 2013, the horizontal black line, when the Naspers effect started inflating the overall South African equity market's valuations. This favourable valuation picture should support the forward return potential for South African equities from current levels. So in closing, let's summarise our current views on global and South African equities. While we're cognizant of the potential for a pullback or correction in global and South African equities during the remainder of 2021, which could constrain the magnitude of returns from here, we are comfortable that the fundamental support from easy monetary and fiscal policy settings and decent corporate profits should limit the potential downside risk for equities as an asset class, and thus still justify a preference for equities within global asset classes, and particularly for attractively valued local equities in our portfolios. Thanks very much for listening. Stay safe and stay invested in global and South African equities.
Next, we have Tamile Sutu, a fund manager in our fixed income team. He will be giving us an update on the global and local bond markets and the effects of inflation on the bond market.
Thank you, Simni. Good morning, everyone. With the US Federal Reserve Board, popularly known as the Fed, hinting at a possibility of the inflation rate breaching the 2% target it has set, markets and market participants started to think of what a reflationary environment would mean for global markets. Over the last few years, and for most of 2020, owing to the coronavirus pandemic, we have largely been in a deflationary environment. Reflation refers to the expansion of the level of output in an economy by government stimulus using either fiscal or monetary policy. The reflationary monetary policy tools at the disposal of central banks is lower interest rates and asset purchases, and the fiscal tools at the disposal of the government are direct stimulus checks, infrastructure spend, and lowering the tax rates. With the large fiscal stimulus that various governments have put in place, reflation now seems like a reality. In response to the economic crisis that was caused by the lockdowns, central banks around the world cut benchmark interest rates to unprecedented levels across the globe. In addition to rate cuts, central banks have also done asset purchases, mostly of the respective government bonds, in an effort to keep government bond markets buoyed and their respective government borrowing rates low. In effort to pull economies out of the 2008 global financial crisis, developed market economies put in place fiscal stimulus packages. However, emerging markets didn't really follow suit, with their focus being mainly monetary policy interventions. However, in response to the COVID-19 crisis, we saw several emerging market economies put in place fiscal measures that are significant when measured as a percentage of GDP. This level of monetary policy stimulus, coupled with the fiscal interventions of the various governments, in my opinion, is reflationary. But does it lead to inflation? In the first half of the year, we saw a rise in commodity prices, such as oil and precious metals, and the strength of the US inflation data also took investors by surprise. In April, month-on-month US headline inflation was 0.8% versus consensus forecasts of 0.2%. This was also the highest month-on-month inflation reading since 1981. US month-on-month inflation continued to rise in May, and with bated breath, we await the June data. Elsewhere, in the developed markets, the Bank of England kept monetary policy on hold and asset purchases unchanged. It did, however, highlight that purchases could be slowed going forward, meaning they will slow their stimulus efforts. In emerging markets, we saw the central banks of Russia, Brazil, Mexico, and Turkey hike interest rates as key inflation data pointed to elevated levels that central banks are not comfortable with. The National Bank of Poland and the South African Reserve Bank have also indicated that they are ready to respond to observed inflationary pressures. For the last few years, bond markets haven't had to concern themselves with inflation and the risks it poses to bond yields. Inflation erodes the purchasing power of the bond's future cash flows. Put simply, the higher the current rate of inflation and the higher the expected future rates of inflation, the higher the yields will rise across the yield curve, as investors will demand this higher yield to compensate them for the inflation risk. The low inflation environment experienced over the last few years has favored bonds, especially high-yielding emerging market government bonds such as those issued by the South African government. The year-to-date return of the FTSE World Government Bond Index, WGBI, was a negative 3.74% in dollars, with the index falling sharply after the April US CPI print. This is in line with my earlier statement on how inflation affects bond markets. We had already seen the US 10-year treasury rise sharply at the end of the first quarter of 2021, as the bond market started to anticipate the rise in US CPI. At the June meeting, the US Federal Open Market Committee officials, popularly known as the FOMC, raised their forecast for inflation in 2021 to 3.4%, up from 2.4% in March. At the same time, they upgraded their projection for economic growth to 7%, up from 6.5% previously. Most members of the FOMC brought forward predictions for the bank's first post-COVID interest rate hike to 2023. Some analysts have cited concerns that inflation rising too quickly could force the central bank to raise rates in future, putting a dampener on the economy. Looking at the US break-even rates, the difference in yield between inflation-linked and nominal bonds of the same maturity, we see that the market disagrees with the FOMC. Locally, in line with the market consensus, the South African Reserve Bank, or SAPY Monetary Policy Committee, voted to leave the repo rate unchanged at 3.5% at the end of their last meeting. South African inflation printed its lowest level in 15 years in April 2020, printing at 3%. This low print set the base for the year-on-year print we saw in May 2021. In May 2021, CPI printed at 5.2%, which is a 30-month high. Looking forward for the rest of 2021 and into 2022, the SARB has hinted that it is concerned about inflation and inflationary pressures, and as mentioned earlier, they are ready to respond. However, the SARB has also indicated that economic growth remains a challenge in South Africa, and that the central bank is cognizant of this challenge facing the country. The SARB interventions at the height of the COVID-19 crisis helped stabilize the South African government bond market and keep interest rates low. As such, South African government bonds had a fantastic run in 2020 and gave investors good returns after having fallen sharply in March 2020. But this run has slowed down year to date, as bond market investors wait to see what happens with inflation, policy rates, and government finances. Year to date, the JSE Composite Inflation-Linked Bond Index, otherwise known as the SILI, outperformed the All Bond Index, popularly known as the ALBI. This is in line with the high inflation prints we have seen, which have made bond market investors seek inflation protection over nominal yields. Now, this wouldn't be a fixed income update without giving you an update on what is happening in the credit markets and especially with the land bank. Due to the COVID-19 crisis, we saw credit issuance reduce drastically in 2020. 2021 has had a better start. Trading activity in the local debt market accelerated considerably in February and March this year. The financial sector and banks accounted for 63% of all issuance. Though bank spreads have compressed significantly, these auctions were strong and well supported across the different banks, as evidenced by the bid cover ratios. There is still a number of funds that need to meet their credit mandates, and we believe more issuers will respond on the back of the successful bank and other corporate auctions, thereby establishing a clearer pricing point and to possibly benefit from the current favorable market backdrop evidenced by these previous auctions. We also saw African Bank return to the local debt capital markets for the first time since the default event in 2014, issuing 94% of the volume it sought to issue in a 3-year floating rate note within price guidance. As we know, SOE credits play an important role in the South African fixed income landscape, and with the Land Bank going into an event of default in April 2020, this all-important asset class has come under pressure. Lending to SOEs by debt capital market lenders such as Momentum Investments has slowed down, and SOE credit spreads have widened and remain at elevated levels. Amid the various SOE struggles to raise funding in the local DCM, there has been good volume trading in both primary and secondary markets. Transnet managed to print 400 million new 12-month paper, while Eskom and DBSA paper changed hands in the secondary market. In April 2020, we saw the Land Bank go into an event of default, failing to pay bond maturities and interest payments for a period. We have come a long way from then, with interest payments having been caught up. We also now have a proposed liability solution, and negotiations between the Land Bank, National Treasury, and various lender groups are progressing well. We believe that the Land Bank should be out of default by October 2021. What remains to be seen is whether investors will rush back into supporting SOE lending en masse post this default. Thank you everyone for taking the time to listen to me this morning.
Lawrence Koikoi, a fund manager in our listed property team, will be talking about what the global real estate sector went through in the past year, the effects of COVID-19 on the asset class, and how our property funds are positioned.
Thank you, Simni. Good morning. Looking back over the last year, it certainly goes without saying that the global real estate sector went through an upheaval in 2020. The asset class suffered its worst year due to the outbreak of COVID-19 pandemic and the restrictions that were imposed to cap the spread of the virus. As was the case in most markets, the South African listed property market was not spared in that sell-off. As you can see on this chart, we saw share prices of property companies and real estate investment trusts collapsing to levels not seen in the history of the asset class in South Africa. Markets became concerned about the impact of COVID-19 pandemic on the economy, the financial impact of trading restrictions that were imposed on shopping centers, and the impact of corporates not physically occupying spaces. Given the unprecedented nature of the situation we faced last year, these were all valid concerns. However, as a team, we spent a substantial amount of time at the onset of COVID-19 pandemic, reconciling what was happening in markets with what we were seeing in the real economy. And also, where there was a disconnect, testing our assumptions relative to market expectations to decide for ourselves whether we agreed with the valuations that market ascribed to property companies. One of the fundamental indicators we looked at to measure the stress on the real estate market was rental collections. The chart shows the break-even occupancy rates in red bars, which measures the minimum level of occupancy rates required before REITs are cash flow negative. On the other hand, the green bars show the current occupancy rates for each of the property companies. The point here is that notwithstanding reduced physical presence at either malls or offices, tenants continue to occupy space in line with their contractual agreements. And with that, occupancy levels remained at levels high enough that REITs remain cash flow positive at the height of the crisis in 2020. Of course, while the previous slide certainly helps in giving some context around the extent to which occupancies in the sector needed to fall before property companies started generating losses, it does not tell the whole story. The reality is that spaces can remain occupied by tenants, but the question is, are REITs collecting rentals on the space that has been occupied? In the early parts of 2020 calendar year, tenants, particularly in the retail sector, saw foot traffic in shopping centers reducing materially, which affected retail sales. This resulted in many retailers, including restaurants, health and beauty, amongst others, facing a cash flow crunch as they were not able to trade. With the recognition of the challenges that retail sector was facing, we saw REITs providing relief packages to tenants, which came in a form of rental discounts and deferrals. This chart shows the progression of rental collection for the sector since the hard lockdowns in April 2020. Clearly, the months of April and May were difficult months. Rental collections over the period ranged between 60% and 70% of what was invoiced. However, we've seen a gradual improvement in collections as restrictions were lifted, leading to improved visibility throughout the year. In the previous two charts, we made a point that occupancy rates for the sector remained high through the pandemic. In fact, occupancy rates remain consistently higher than break-even occupancy rates. In addition, REITs remained in a cash flow positive state throughout the course of the year. But in truth, that is not enough because providers of financing to property companies have put in place measures to protect their capital, and they will start getting worried and to a certain extent involved as soon as rental income drops to levels that starts to threaten the receipt of their capital and interest. So REITs have largely complied with the debt covenants, and banks were also pragmatic with their approach in resolving breach covenants. The question to ask is how much headroom do real estate companies have before breaching their covenants? Our research shows that property values would have to fall by another 25% for REITs to breach their loan-to-value covenants. On the income side, net operating income would have to fall by additional 40% for the interest cover ratio to be breached. This includes income already lost from concession offered to tenants. So barring two REITs which had to request covenant relaxation for last year, REITs largely complied with their debt metrics and have reasonable headroom before covenants are breached. The other indicator, which was very useful to use as a guide to test whether markets were rational and their pricing, was working out the extent to which market expected property values to decline using spot share prices. At the height of the COVID-19 lockdown, share prices of REITs on average traded at 50% discount to net asset value reported on their balance sheet. Based on this pricing, market participants expected property values to fall by 30% from peak to trough, which is shown in the blue bars. We disagreed with the pricing expectations throughout the course of last year, as our work suggested that the market was too bearish in their expectations. With the progress made on finding vaccines in November, we saw a strong rebound in share prices of REITs. The sector rallied about 30% since November 2020, bringing total returns since lowest levels in March 2020 to about 55%. When we look at pricing expectations, we agree broadly with the aggregate property decline that the market is pricing in. While still on the topic of property values, the COVID-19 pandemic served as a catalyst for write-downs we've seen in the sector since last year. Based on our calculations, REITs have seen their values dropping by 8% on a cumulative basis since June last year. One of the questions we typically get asked is, have values bottomed, or are we likely to see further write-downs from the current levels? And if so, how soon do values recover? On this slide, we show peak to trough movements in South African property values during different crisis events. That is, the global financial crisis and the periods including Asian financial crisis and the September 2001 attacks. The slide also shows the length of time it took for SA property valuations to recover back to pre-crisis levels. The interesting observation here is that devaluation cycles can be protracted, taking up to 5 years to reach the trough. But the recovery back to peak levels has historically been shorter, taking up to 3 years to go back to historic peaks. So, have values troughed? Based on our view, there's a risk of further downside over the next few reporting periods, as we believe demand and supply dynamics remain out of balance. However, not all property companies will experience the same decline in values. But the point is values do recover when economic activity and real estate fundamentals improve. However, The pace of the recovery depends on the supply and demand fundamentals, which remains a key anchor of our view on the sector. So with that, what are we looking for in the sector? Starting with the office supply, we've seen the amount of space that developers are introducing to the market coming to a halt in 2020. So far, there's only 43,000 square meters of development currently on the ground. This represents the lowest level of supply we've seen in market over 30 years. We do not expect to see any supply coming through in the market over the next few years, which will be positive for absorption and rental income growth should demand come back on stream. However, while supply of offices is constrained and at all-time lows, we've seen vacancies in the office sector deteriorating and approaching 2003 peak levels. We think that an important indicator to monitor is what tenant intentions are going forward. With that, we think that the emergence of trends such as hybrid working and subletting of space will exacerbate the deterioration, making this picture worse before we see an improvement. On the retail side, we've seen vacancy rates continue to rise in the last 12 months, which is the trend that has been ongoing for several years. Again, tenant intentions are generally more focused on consolidation than on expanding. Woolworths has communicated to the market in terms of their future space requirements, with the retailer planning to cut about 15% of apparel space between now and June 2023. On the food side, the business is doing relatively well, and the company plans to add space on that front over the next 2 years. On a net basis, the group will shed space over the next few years on their non-discretionary offering. With the backdrop of relatively challenging operating environment that we have painted and the weakness we anticipate over the next few months, our daily focus remains on ensuring that we have positioned the portfolio towards companies that can withstand pressures in the market. As a team, we maintain a focus on sustainable earnings and investing in companies that will continue to grow earnings higher than peers on the back of supportive real estate fundamentals. We believe that there are good investment opportunities in the sector, with REITs that can continue to provide the yield underpin that investors require in the portfolio, with added diversification benefit expected from the asset class. Thank you for your time today.
Wayne Dennehy, the head of systematic strategies and smart beta, will look at how the SA equity market fared in the past year and which sectors benefited from this pandemic.
Thank you, Simni, and good morning, ladies and gentlemen. It's great to be joining you in one of our new studios this morning. SA Equities. But before we dive right in and have a look at what the market's done in the last 12 months, I thought it'd be great just to do a quick recap of how did things look when we last spoke on this platform in August 2020. What we can see on the first graph, if you look at the grey lines, is that 12 months ending 31 August, SA Equities had only given us 3.4% for the preceding 12 months. SA Financials, SA Listed Property, completely decimated, down 30% and 44% respectively. And our resource stocks starting to shine, bringing that fire into rejuvenating SA Equities. We made the point last time that when the market goes into financial crisis, when everything starts to fall down, that's when gold really comes to the fore. Because after all, you buy gold because you don't trust whatever government you might be in. And gold up nearly 29% for the 12 months. Oil down 23%. And I remember distinctly at the beginning of the first part of lockdown when oil futures actually went negative, something I've never seen in my 30 years in financial services. And on the far right-hand side, we can see from the various offshore equity markets that pretty much anywhere you had a strong positive return. But looking at the far right, that in the context of the rand being nearly 12% weaker for the 12 months ending August last year. Roll the clock forward, and how do markets look at the end of April 2021? Looking at the grey bars once again, SA Equities up around 36% for the 12 months ending the end of April. But what you don't see, despite it looking very positive across all sectors, if you look at it on a rolling 3-year basis to the end of April, SA Financials down around 8% per annum for the last 3 years, and SA listed property down around 12% per annum for the 3 years ending the end of April. Inflation-linked bonds, nominal bonds, really strong returns, and cash at around 4.3% for the 12 months ending April, certainly at the lowest levels that I have certainly seen in the last 10 years. If we look at oil, up around 138%, so clearly that's boded extremely well for Sasol, as you're going to see later. And looking at the green lines once again, strong returns from the various offshore equity markets. And that in the context, if you look at the far right-hand side, that the rand is roughly 22% stronger than where we were 12 months ago. It might be a surprise to some of us that the Nikkei index was in fact up around 100% for the 12 months ending the end of April. And still, it's the UK that seems to be lagging. Where did you not want to be invested? Certainly offshore bonds, where the return there is minus 18%, pretty much what the rand weakened by, or what the rand strengthened by for the last 12 months. Looking at some of the sectors on the next slide, and I'm not going to go through all of these sectors, but just to look at some of the sectors that are doing well, that did really well up to the end of March. There you can see some of our SA chemical shares up around 300%, alternative energy also up around 300%. Oil, a big gainer, as you can see, up about 95%, so clearly that's boded well for Sasol. And in the metals and mining space, up around 100% for the 12 months ending March. Looking at the bottom right-hand part of the slide, what are the losers? Well, sort of clearly food, up only around 9%. Shares such as BAT, really struggling in a sort of consequence of what we saw in the various lockdown scenarios. Healthcare providers and non-life insurance, so your short-term insurers, under tremendous pressure, as we can see. Banks, well, banks up around 47%. But let's not forget how those shares got completely decimated in February and March last year. But on the whole topic of banks, it does remind me of one of my favorite stories on that particular theme, and that is the story around compound interest. Often seen as the 8th wonder of the world. Those that understand it, earn it. Those that don't, pay it. Looking at the next slide, and we did look at this slide last time, we're looking here in SA Equities, how are the active equity managers performing relative to the opportunity set, or relative to our market, to your sort of normal market index fund. And what the graph is showing is over the preceding 12 months, are active equity managers on average managing to do better than the market, or better than a normal market index fund, or worse? So if the blue line is higher than the x-axis, active equity managers in general are adding value on a rolling 12-month basis. And if the blue line is below the x-axis, they are not able to beat the market over the previous 12 months. If you look at the big red arrow, it shows you that certainly in the last 12 months, and pretty much since COVID started, active equity managers have been able to add value, have managed to do better than market. And one would certainly hope so. In times of this market volatility and this sort of market dislocation, one would really hope this is when active equity managers can add value for client portfolios. I then often get asked, Wayne, why would I ever buy a market index fund if I'm guaranteed to only earn the market? And in fact, net of fees, I'm guaranteed to underperform the market. Why would I ever buy this thing? I don't know if you've ever heard that comment, but I've certainly heard that comment several times throughout my career. And yes, it is true. If you buy the index fund, I'm going to earn the market. And yes, net of fees, I'm going to slightly underperform the market. But the key is those fees are very, very low, so you're going to slightly do worse than market. But look at the graph. There's times throughout the last 12 to 14 years where active equity managers struggle to even give you the market. So index funds, in my view, always have a place in your client portfolio. They are your anchor bet. They're that part of your portfolio that you simply can't get wrong. I'm going to earn the market, and then you implement certain active funds and active managers all around that. And I'm going to show you later how the Momentum Capped Swex Index Fund has performed over the previous 12 months. Looking at the next slide, from a SA listed property perspective, exactly the same sort of scenario. Are active managers or active funds in SA listed property able to outperform the market opportunity set? And here you can see that they are consistently able to add value to clients. Yes, this particular sector has been decimated. It's down 12% per annum over the last 3 years. but there certainly has been value in using active managers in this part of your portfolio. Right, looking at the next slide, the one theme that definitely plays out in SA equities is what is happening with the Rand. And the Rand has been really strong over the last 2 years relative to the US dollar and relative to a basket of various other emerging market currencies. So looking at the first graph, what we're looking at here in blue is how has the Rand fared relative to the US dollar over the last 2 years. And you can see at the bottom of that graph, in the middle of COVID, probably around about end of March, sort of early April, the Rand was at its worst as we touched on 19 Rand to the US dollar. And in red, what we're showing is how has a basket of various other emerging market currencies fared. And you can see the Rand has significantly outperformed other emerging market currencies over the last 2 years. And on the right-hand side, we look at how's the Rand fared to a basket of various other currencies. And you can see on a year-to-date basis, we've done exceptionally well. We are significantly stronger than where we were at the start of the year. And if you compare it at the bottom of that graph to how it compares to some of the other emerging market currencies, you can see there against the Turkish lira, by example, that's nearly 12% weaker on a year-to-date basis. Looking at the next slide, there's two themes that often play out, and it's always great to see it in a graph as it just makes so much more sense. And that is the theme around what is the actual NASBAS impact on our sort of various SA equities, and what is the impact of our dual listed shares. So looking at the left-hand graph first, we can see in red, if we look at how has the SA All Share Index fared over the last 12 years, and in blue, we plot the same All Share Index, but from a top 100 share perspective, and we exclude NASBAS. And you can see how significantly you would have underperformed the market if you didn't own NASBAS in your SA equity exposure. You would have underperformed the market by probably 15 to 16% over the last 12 years. And on the right-hand side, we show the same graph in red, so our sort of local all-share index. But now we show in blue, if we invested in the top 100 shares, but we exclude NASBAS, and we exclude all of our dual-listed shares. So there you're looking at shares such as SAB Miller, BHP Billiton, Richmond, etc., etc. And now that underperformance is even more severe. You're going to underperform the market by roughly 35% if you don't hold NASBAS and if you don't hold those dual-listed shares. So I think it's a great way to look on two very simple graphs. What is the NASBAS impact and what is the impact of our dual-listed shares? So what do we need in our client portfolios if we build portfolios for clients to make them robust and give them the best chance of success for whatever might lie around the next corner? And to me, you really need three things. You need to be diversified by style. And by style, I'm talking about styles such as value, styles such as momentum or trending, and styles of quality. And yes, there are many other styles that one can hear about in the market. Low vol, low beta, high beta, etc., etc. And I'm certainly not here to tell you that those can't add a layer of extra diversification to your client portfolios. But what I would argue is that if you already have styles of value, momentum, and of a sort of quality in your client portfolio, I'm not necessarily convinced that those extra styles will add that extra layer of market diversification to your client portfolio. The second thing you need is you need multiple funds or multiple different asset managers in your SA equity portfolio. And arguably, this is the one thing I generally see clients getting right. We hold different funds. We hold different underlying investment managers in our client portfolios. But as an example, you could hold 3 different funds, but if they're all value funds, you're certainly not well diversified. You need to be diversified between different funds and between those various styles. And finally, the third thing that I would say you need in your client portfolio to be well diversified is you should be diversified between different active funds as well as between different index funds and smart beta funds. And the smart beta funds really provide something interesting for you to think about. Momentum smart beta funds, of which we have 2, Momentum Value and Momentum Trending Equity, which is the Momentum Risk Premier, have a 4-year track record now. They're very, very cost effective, and they allow you to get a very clinical access to one of those styles, value or momentum or trending, and to implement it by way of a different fund and help clients have more robust portfolios that are diversified further away from just being in various actively managed funds. So bringing it all together, I don't think anyone would disagree with me that if you only invest in one style, you're in for a very bumpy ride. It's going to be a white knuckle fund. You're going to have to hold on for dear life. And I would argue you're going to struggle to keep your clients invested, or if it's your portfolio, you're going to struggle to remain invested through some really, really tough market cycles. The key for success is that you want to blend different styles into your particular equity portfolio. If you're blending in different styles, you have a far better chance of a smoother ride through various market cycles. The third point to me is a very, very big one that you need to bear in mind. I've yet to see any evidence of anyone that can consistently add value by trying to time their entry and exit from certain market styles. So in other words, let's get out of value and get all into momentum trending, or let's get out of quality and go all into value. I don't think that's a long-term winning strategy. You're far better off just making sure that you hold those various styles in your portfolios and let the portfolio run through various market cycles. And finally, as we said, think about blending in active as well as passive and as well as smart beta funds into that ultimate end solution. And on my last slide, I'm going to share some metrics that hopefully bring everything together that we've spoken about this morning. And what we're looking at here is that if we look at the ASISA equity survey, as of the end of March, there's a staggering 164 different equity funds that you can choose from. That includes index funds and includes smart beta funds. If we look at how the best fund performed over the 12 months ending the end of March, the best fund would have given you 101% return, net of fees. That's pretty decent. If you were unlucky enough to be invested in the worst fund over the same period, you would only have got a market return of 9% over the same period. That's a whole lot of buyer's remorse if you happen to be in the wrong equity fund over those 12 months. And there's a great reason why we need to be diversified into different funds and into different investment managers. Look at the index fund. While the momentum index fund would have given you 53% over the 12 months ending the end of March. And in fact, out of 164 funds, it came 59th out of all 164 funds. And that's a pure index fund. It's a straightforward market tracker fund. Very cost effective and definitely worthy of consideration as a core part of your SA equity exposure. And the final line shows one of our two smart beta funds, the Momentum Trending Equity Smart Beta Fund. As I said to you, it does have a 4-year track record now, but for the 3 years ending March 2021, that Smart Beta Fund, that's a passive fund, it's a rules-based fund, and it's very, very cost effective, came 16th out of 164 funds. Very active looking returns, but not active in terms of how it's being run. A great diversification tool to put into your portfolios. The market has really reminded all of us, you need to be well diversified between styles, between funds, and between active and passive managers to try and navigate whatever might well be around the next corner waiting for us. It's a great opportunity for us to rethink what's in our SA equity block. Thank you for joining us this morning. See you soon.
Mutlatse Mutlanyane, our head of alternative investments, will be talking to impact investing and how investors can navigate some of the complexities of environmental, social, and governance factors.
Thank you, Simnikiwe, and good morning and welcome everyone. In the next 20 minutes, I will be discussing impact investing and some of the principles we apply when investing for impact in our funds. Impact investing is an investment theme that's a compelling proposition and an important initiative at this point in time, not just for us as a developing economy, but for the world in general. Impact investing and ESG are on every investor's minds these days, and for good reason. It's a huge success, actually, and essential to solving some of the social and environmental challenges of our time. As the strategy becomes more mainstream, the volume of concepts, definitions, and overall questions continues to grow. The words impact investing, SRI, and ESG investing are generally used interchangeably, even though their approaches are at different points of the sustainable investing continuum. Impact investing describes an approach to investing that enables investors to seek a social and environmental impact alongside a positive financial return. In addition, Impact investing strategies are generally built around achieving the UN's Sustainable Development Goals. We as Momentum Alternative Investments manage for impact through our infrastructure funds. The Momentum Impact Fund, which is a general infrastructure fund, targets CPI plus 6 in addition to social, environmental, and economic impacts. Below that fund, there are 3 specialist funds: the Alternative Energy Fund, our Social Infrastructure Fund, and the Diversified Infrastructure Fund. As the name implies, the Energy Fund invests primarily in operating energy assets in renewable and other power technologies. Our Social Infrastructure Fund holds operating assets in student accommodation and affordable housing. And lastly, the Diversified Funds holds general infrastructure assets like toll roads and airport assets. Our strategies are constructed such that they achieve our target sustainable development goals of good health, quality education, clean energy, economic growth, infrastructure, and climate action. As part of impact management within our portfolios, we focus on 3 main areas, and that is ESG assessment based on our predefined investment criteria, impact assessment based on which impacts we want to achieve and how those will be measured, and thirdly, SDG mapping and alignment. The universe of potential impact investments consists of diverse approaches to tackling social and environmental challenges. It's therefore important to clearly define the impacts that you as an investor might want to target. For example, are you looking for broad thematic environmental outcomes or social outcomes? So social themes include affordable housing, education, health, and job creation, while examples of environmental themes include renewable energy, sustainable infrastructure, and climate change adaptation. Similarly, investors can choose to invest in opportunities that meet specific ESG factors, such as a circular economy, empowerment, and gender equity. And likewise, with green technologies and initiatives, like waste recycling and aquaculture, among many others. The types of investing are based on expected financial return and approach to impact. As this chart shows, expectations can range from complete loss of capital to market rate return. Some investors are happy to give up some return in order to unlock impact, while others have no expectation of financial gain. For passive investors, for instance, impact is not the primary objective when investing. However, these investors will still label their investments as impact. Others in the intentional block, they don't have a measurable impact objective, but are driven more by intention. And another group of investors is more motivated by the need to solve a problem using an evidence-based approach. As I mentioned earlier, our approach to impact is built around infrastructure and macroeconomic themes of energy security, green economy, and employment stimulus. The government's Economic Reconstruction and Recovery Plan is a response to restore and rebuild economic activity. The core elements of this plan are priority interventions for economic recovery, and this is around flagship initiatives that all of society is expected to rally around to build a new economy. And these are listed on this chart. Enabling conditions for growth. These are growth-enhancing reforms and other preconditions for an inclusive and growing economy. Third, a macroeconomic framework that mobilizes resources for fiscal sustainability. If we look, for instance, at the example of energy recovery, some of these initiatives include the recently concluded, but dare I say controversial, risk mitigation power procurement for 2,000 megawatts, the REIPP bid window 5 that will open in the coming months, and then further procurement of some 7,400 megawatts from now until 2030, Eskom rebundling and the resolution of that debt burden, regulatory changes to the threshold to support embedded generation, and hopefully with time, a decentralized power market with competing participants buying and selling power. In particular, the key targets are around reliability, affordability of supply, and environmental sustainability. Infrastructure investment has received the most attention in the last few years, and that's because it's expected that it will spur economic recovery and private investment. For example, the Infrastructure and Investment Office was capacitated in the President's Office and is coordinating many of the infrastructure initiatives in the public sector at the moment. The Infrastructure Fund is operating from the DBSA and is already working on a bankable project pipeline of some 340 billion. The easing of pension fund restrictions on infrastructure investment, priority development objectives of employment creation, enterprise development, and the green economy. You may ask, why has impact measurement taken center stage now? Well, the conversation around impact measurement has evolved from accountability to value. Investors now need to gather the data, they need to analyze it, learn from it, and use that knowledge to improve upon impact practices and create more value for all stakeholders. The main reasons impact needs to be measured are, first, to better understand the impact. This is because there's a recognition that ESG factors affect both risk and return. Secondly, to proactively report impacts to stakeholders because they are demanding greater transparency about how their funds are invested. And thirdly, to comply with regulations. There is now good guidance on how ESG factors should be included in risk management. ESG comes first in impact measurement. There's no impact investing without first incorporating ESG. Potential negative effects of an investment must be considered, and there are always effects, no matter the type of investment. One of the greatest risks of mobilizing capital to the impact sector is the potential for impact washing. Impact investors need to be looking behind the curtain on investments to maintain credibility. There are many examples of investments and funds being marketed as impact investments without the impact management practices in place to substantiate this label. What are the requirements for impact measurement? Well, as I mentioned earlier, collecting, measuring, and harmonizing impact data, transparency, and that means independent verification, resource efficiency, so that's repeatability of measurement, and a lean approach that avoids collecting too much data that dilutes the overall impact. Many impact investors began by developing their own matrix to track social and impact performance on spreadsheets, much like we did. These practices are now beginning to coalesce into a set of good practices. Now we've moved to several online tools and platforms that have also been developed to bring more consistency to measurement and reporting. Examples of these include the Pulse, which was developed by Google to track impact, Iris Plus, which was developed by the GIIN, the Global Impact Investing Network, and this is probably the most widely used measurement instrument. And then Delta, that is Development, Effectiveness, Learning, Tracking and Assessment tool. It's a scoring system for additionality and impact that was developed by the Inter-America Development Bank Invest. And then AIM, and that is Anticipated Impact Measurement and Monitoring, which measures project development impact in terms of outcome and market impact. This is a tool that's widely used by the IFC. Ultimately, the objective of all of this is to see a world radically changed for good. Achieving impact will create a world that's more sustainable, more equitable, and more prosperous. In order to get there, investors must adapt their strategies to deliver not only financial results, but positive social and environmental outcomes as well. Unlike measuring financial returns, impact measurement is still in development phase, and investors should engage in a learning process to maximize social impact. Investors should be setting transparent long-term financial and impact goals and design a clear investment thesis with measurable actions to achieve these goals. And to do that, we suggest investors should follow these steps, and they should ask these questions. 1, what impact do I want to achieve? So am I looking for a social or environmental impact? 2, what liquidity and risk profile am I looking for? 3, What is the appropriate impact investing vehicle to use for this? So for example, do I go direct? Do I go through an impact fund, a passive approach, or a blended option? And then 4, how do I measure the intended impact? I hope you have found this discussion useful. Please contact us if you'd like to discuss impact investing in more detail. Thank you.
To end off today's session, Theo Tablanche, our Executive Head of Investment Management, will give us a summary and some closing comments.
Thank you, Simni, and good morning, everyone. Simni mentioned our virtual studio earlier, and I can tell you, for me, the world has certainly moved in a very different direction. Right now, it might look like I'm in studio with my colleagues, but in reality, I'm actually self-isolating at home and coming to you live from my garage where I've set up my green screen. Thank you for joining us for another version of A Moment with Your Investment Gurus. I realize there are multiple webinars and online content available for you to choose from, and we appreciate the time that you've afforded us this morning to share some of our capabilities and the views of our portfolio managers. The biggest part of my focus over the last year in managing our investment management business has been to ensure that we've got the right skills, staff, and offering organized in a way to answer our clients' evolving needs and to make us competitive as an investment business. I would like to take this opportunity in closing to give you a brief update. At Momentum Investments, our key objective is to achieve long-term sustainable returns for our clients that solve for their stated outcomes. We believe in and value diversity, and we recognize our responsibility as custodians of our clients' investments. We fully subscribe to the principles of responsible investing, and we aim to invest for a better future for our clients, community, staff, and South Africa in general. I hope you've all had the chance to look at our stewardship report on the website and have seen the various initiatives that we have successfully completed and have underway in this regard. We have a wide range of portfolios and solutions designed to achieve this stated objective. Through our Momentum Outcomes-Based Solutions business, we offer a range of multi-asset class solutions designed to provide the best chance of reaching a CPI-based target. These portfolios are best used as a complete solution to a client's investment needs or as a core to any investment portfolio. Our global solutions team at Momentum Global Investment Management in London works in lockstep with our local team to ensure that we cover global assets that will work in our portfolios. We spent a great deal of time during the last year in our Momentum Asset Management business ensuring we have world-class asset management capabilities and an offering that's relevant, competitive, and appropriately priced. We're already a significant player in the industry with sizable assets under management, and we aim to significantly grow this in future. We offer our clients and advisors a range of fixed income, listed property, passive and smart beta funds to use in their portfolio construction process. Our Momentum Alternative Investment business offers a range of private equity and hedge funds, and we're especially excited about a new range of impact portfolios that will be launched soon. Investing in alternative asset classes provides us the opportunity for improved returns for clients, while at the same time also fulfilling our ambition to do good for society. We've established a research hub in our business and tasked them with researching and developing new ways of understanding our clients and their behaviors, innovative technologies, and new investment ideas. I look forward to sharing more of this with you in future. 15 months after the onset of the COVID-19 pandemic and the absolute chaos it's created in markets worldwide, the world remains an uncertain place. Markets have rallied strongly after the lows of the previous year, but concerns about the sustainability of this run in light of higher global inflation has caused some anxiety. As always, there are opportunities across different asset classes and different sectors, and at Momentum Investments we go to great lengths identifying these opportunities. We have skilled and experienced teams of professionals looking after your investments, and you've heard their views about these opportunities and how they position their portfolios this morning. Some of the key takeaways for me were, while there's a risk of a correction in global and local equity markets after the good returns over the first half of the year, improved corporate profits post the pandemic should limit the potential downside risk. Global inflation has started to rise after a sustained period of deflation, resulting in an increase in yields worldwide. Locally, the Reserve Bank is also concerned about rising inflation, but has the added complexity of a low economic growth to consider in their interest rate decisions. The global real estate sector went through difficult times in 2020, with lockdowns and working from home driving changes in valuations. We've seen valuations recover somewhat of late as sentiment lifted with the global vaccination drives, but downside risk remains in this sector. While investing in smart beta portfolios provides you with a way to diversify between active and passive management, it's also important to diversify between different styles of equity investing within a smart beta portfolio, and one should avoid trying to time these styles. Investors should at the same time set themselves long-term financial as well as impact goals when designing an investment plan. Investment managers, on the other hand, must ensure that their impact investment strategies are both measurable and can demonstrate the change that it seeks to bring in society. Certainly a lot to think about as you navigate your clients' investments during these uncertain times. I hope today's session will have given you some insight and will help you with your decision-making process. I trust that you've enjoyed today with us and would like to thank you for your ongoing support. A reminder that this full video will be hosted on our website on momentum.co.za under Investments and Savings. If you've watched the full session, your CPD certificate will be emailed to you once CPD points have been authorized. I hope to see you all again soon and to share more of our insights and plans with you. Thank you for your attendance, and please look after yourself and your loved ones. Goodbye.